Venture capital operates on a completely different playing field compared to traditional investing. In most asset classes, returns follow a predictable pattern, a bell curve distribution, where the majority of investments yield moderate returns, a few perform exceptionally well, and a few underperform. But in venture capital, the rules are different. Returns are driven by the power law curve, where just a handful of investments generate the vast majority of the returns. This dynamic is critical to understand, both for investors and for startup founders. In most industries, spreading risk evenly across a portfolio leads to steady profits. But in venture capital, success often comes down to just one or two breakout investments. A single massive winner can make up for dozens of failed bets and define the success of an entire fund. The power law curve in venture capital means that only a small percentage of startups, typically 5 to 10%, deliver astronomical returns, sometimes multiplying an initial investment by 50, 100, or even 1,000 times. Meanwhile, the majority, around 50 to 70%, either fail completely or return less than the original investment. Another 10 to 30% may generate moderate gains, perhaps doubling or tripling the initial investment, but these returns don't significantly impact the overall fund's performance. Some of the most legendary venture capital deals illustrate this reality. Take Sequoia Capital's investment in WhatsApp, for example. They put in $60 million, and when Facebook acquired WhatsApp for $19 billion, their stake was worth over $3 billion, an astounding 50x return. Benchmark Capital's early investment in Uber turned $12 million into more than $7 billion at the time of the IPO, a 500x return. And Andreessen Horowitz's $250,000 bet on Instagram grew into a $78 million payday in just 2 years, delivering a 312x return. Each of these deals alone transformed the entire performance of the funds that backed them. This is why venture capital isn't about spreading money across many safe bets. It's about finding and backing the rare startups that will change industries and create massive wealth. In traditional investing, returns follow a bell curve. If you look at stock markets, real estate, or private equity buyouts, you'll see that most investments produce fairly consistent results. In private equity, for example, a firm might invest in 10 companies, where 2 generate strong returns of 3 to 5 times the initial investment, 6 deliver modest returns of 1.5 to 2 times, and 2 underperform. In this scenario, every investment contributes meaningfully to the fund's returns, and risk is balanced across the portfolio. But venture capital doesn't work that way. Instead of most investments delivering moderate gains, the vast majority either fail or provide small returns, while a tiny fraction produce extraordinary, exponential outcomes. This is why the entire venture capital model is built around hunting for outliers rather than minimizing losses. For venture capital firms, this means structuring their strategy around the power law. To maximize their chances of capturing one of these outliers, they must invest in a large number of startups. Since only a small percentage will become massive successes, a fund needs enough bets placed to increase the odds of backing the next billion-dollar company. They also need to embrace high-risk, high-reward ideas. Safe, incremental businesses rarely generate the kind of exponential returns that drive venture capital success. And when they do find a winner, they double down, making follow-on investments in the highest-performing startups to concentrate capital where it has the greatest potential to return the entire fund. Perhaps most importantly, they accept a high failure rate as part of the game. Most of their investments won't succeed, and that's okay as long as 1 or 2 become industry-defining companies. For venture capitalists, internalizing the power law dynamic is paramount. It explains why you can't settle for merely good businesses. You have to target the rare opportunities that can compound into unicorns. A company that lacks true scalability potential should never make it past your initial filter. And once you do invest, you need to set the expectation and provide the resources for rapid, breakout growth. Plateauing portfolio companies call for hard conversations or an early exit because stagnation erodes fund performance. Practically, this means every deal you underwrite must have a credible path to 10 times revenue growth within a few years. During screening and due diligence, interrogate the scalability of the business model, the total addressable market, and the founding team's ambition. After the initial check, Monitor traction relentlessly. If a company isn't demonstrating exponential momentum by the Series A, B window, you either double down on the true outliers in the portfolio or reallocate follow-on capital elsewhere. The danger of misunderstanding the power law is one of the biggest pitfalls for both new investors and founders. Many first-time venture capitalists make the mistake of investing too conservatively, expecting every startup in their portfolio to provide some return. But if they never back a true outlier, their fund will ultimately underperform. Similarly, some founders believe that early profitability is the key to securing venture capital. But in the world of VC-backed startups, profitability is often secondary to rapid growth and market dominance. A company that focuses too much on avoiding failure rather than maximizing upside may miss out on the opportunity to scale into a major player. Legendary investor Peter Thiel summed it up best. The biggest secret in venture capital is that the best investment in a successful fund equals or outperforms the entire rest of the fund combined. This isn't just a theory. It's a fundamental truth of venture capital economics. It explains why VCs are always searching for the next billion-dollar company rather than investing evenly across a portfolio of good businesses. For investors, this means embracing the reality that one big win can define an entire fund. It means making bold bets on outliers rather than playing it safe. And it means being comfortable with a high failure rate, because in venture capital, failure is the cost of chasing extraordinary success. For you as a VC, scale trumps early profitability. Your mandate is to back companies capable of redefining markets, not ones that are merely sustainable. Push your founders to think bigger, move faster, and embrace the pressure that accompanies venture backing. The goal isn't to build a solid small business. It's to help create an enterprise so transformative that it rewrites the rules of an industry, and, in doing so, drives the power law returns your fund is built on. That's why the power law isn't just an interesting concept. It's the foundation of everything in venture capital. Venture capital operates under the power law, where only a few investments produce extraordinary returns while most fail. This forces VCs to invest in high-risk, high-reward startups with massive scalability potential. Founders seeking VC funding must focus on aggressive growth rather than early profitability, as investors expect rapid expansion and market dominance. Understanding the power law is crucial for both VCs and founders. It's what separates transformative companies from those that merely survive.